Yo, what's up, y'all? Welcome to episode 14 of Plug Talk Tuesday. Let's grow. Today, we're going to talk about interest. And interest is something that impacts everybody, regardless of your race or your economic status. We're all impacted by interest in some way, shape, or form. So, what is interest? Interest is the cost of money. Again, interest is essentially the cost of money. It's a percentage that tells you how much you're going to have to pay for said product. It impacts people when it comes to credit cards, cars, houses, loans, even student loans. But your student loan interest rate is based off of what the government says and not necessarily your credit score, which we'll get to in a second. All of these areas have an interest score attached to them when you decide to borrow something from the institution that's loaning it. So if you're financing a car or you're leasing a car, you're going to have an interest rate with it. And you have a credit card and you allow there to be a balance on it, you're going to have an interest rate with it. If you're buying a house with a mortgage and not paying all cash, you're getting a loan from the bank, which is going to have a specific interest rate to it. If you're getting a loan from a bank, a personal loan, a private loan, a business loan, it's going to have an interest rate with it. And again, interest is the cost of money. So if we know interest is the cost of money, when we see that score, we know how much extra we're going to have to pay on top of the principal. So that's something to know. The principal is the exact amount that you paid for said product. The interest is how much extra you have to pay in order to borrow that money from the bank. So when it comes to like a home loan, you might hear the term PITI. That stands for principal, interest, taxes, and insurance. So a lot of people's mortgages will be made up of PITI, principal and interest. So when you're paying down on a mortgage, you're not just paying the actual price of the home, you're paying that interest rate. Hence why a lot of people are trying to buy homes right now, because the interest rates are so low. Historic lows of 2 point something, right? When's the last time we've seen something like that? So a lot of people are trying to lock in home loans right now for 30-year mortgages because they want to be able to pay a really low interest rate because of that. The same right now goes for a lot of other areas when it comes to cars and private or business loans as well. So here's the key though. The better your credit score, the better your interest rate. Now again, the better your credit score, the better your interest rate. And this applies to majority of places. Sometimes this doesn't really apply to credit cards because they like to just have high interest rates anyways, but a good credit score can increase the amount of credit you have available to you, and then the interest rate is still pretty high because of the type of product it is. But when it comes to a mortgage, a car loan, a personal loan, a business loan, things like that, the better your credit score, the less you have to pay in interest. Why? Because our credit score is simply our responsibility score. And if we remember, our responsibility score simply tells them I'm responsible when it comes to dealing with money. So they're going to loan you money at a lower rate because your credit score is higher. End of story. So again, it's pretty much the better credit score you have, the less you have to pay to borrow money, which is why it's really important if you're trying to get into whether it be the real estate game, or you want to be able to utilize credit cards, or you want to be able to lease and finance cars and pay less money for it in the long term, for you to be able to have a better credit score, because that's the less money you have to pay in the long run. It's also important to know that interest goes both ways. Not only do you have to pay the bank's interest, there's ways that the banks can pay you interest as well, right? Because it's all about the borrowing game. It's the cost of money, because banks, when you house your money in a bank, they pretty much use your money. So when you decide to deposit your money, checking or savings into a specific account, the bank will give you a certain percentage, again, an interest, with you being able to house your money there with them. When you do that, they pay you a small amount back for saying thank you for leaving your money with us, because now we can do business with your money because you house your money with us, right? Again, that's the name of the game. But a lot of times you have to watch out, because a lot of commercial banks, US Bank, Bank of America, Chase, places like that, they give you like a 0.01% interest on your money. That's like nothing. And right now, they're probably literally giving you nothing, 0.0001% on your money because of where we're at in the economy right now. But then there are other things called high interest yield savings account. Now, they're not very high anymore, again, because of the economy, but a couple years ago, they were really high, giving you 2 point something. Some would give you 3 point something for storing your money with them. And this was really beneficial because if you were to store your money with a high interest yield savings account, you would get more money back for storing your money with these types of accounts. You get more money there versus storing it in a commercial bank because they wouldn't be giving you that much interest for housing your money there. Now, through the last year, I've been able to watch my high interest yield savings account interest plummet because of what's going on. They can't afford to pay you as much money as they used to because of where the interest rates are right now in the country. So there's not that big of a difference between a commercial bank and a high interest yield savings account, if you even want to call it that anymore. This is also really similar to a CD, which is a certificate deposit, where before they used to be able to give you maybe 5% for holding your money, again, in a specific spot, 5% interest back on the money you give them to hold on to for a couple of years. Now, it's probably not even really worth it because they're not able to give you as much money back. It may not be really worth your time to be able to do that type of investment. But it's important for you to know that there's two ways when it comes to interest. The bank charging you interest to borrow money from them, and then you being able to get interest from the bank because you're allowing them to borrow your money. So it's really important for you to think about this when you go to choose a bank is, who do I want to make money off of me? That's really the decision that you're making. Not only are you just putting your money somewhere, but you're also allowing that bank to utilize your money. And then they also go out and do different things with your money. So you might want to start thinking really critically conscious about where you're putting your money at. And if you're able to make more money somewhere else versus where you're already putting your money at. So you might be thinking, okay, I have a really high interest rate on my car. I have a really high interest rate on my house. So what can I do? How do I get my interest rate lower? Well, one thing that you can do is you can refi. It's called refinancing. And right now is a really good time to refi simply because the interest rates are so low. So if before you locked yourself into a specific interest rate and you've increased your credit score, now might be a good time to refinance so that way you can lock in an even lower rate at this point in time. Another thing that some people do in order to decrease their current payment, but elongate the amount, is they may stretch out the amount of months or stretch out the amount of years that they have said loan. Because when you do that, that allows you to be able to pay a monthly payment, a lower monthly payment, but you end up spending more in the long run because of the amount of interest you're paying, over time. And then the best way for you to be able to decrease the amount that you're paying in interest on anything is to be able to increase your credit score. So if you're saying, I want to be able to take advantage of these rates that are going on right now, whether it be houses or cars or whatever the case may be, is the best thing for you to do is spend time investing in increasing your credit score. Because when you increase your credit score, that shows banks and institutions that you're responsible with money. So when they go to give you money, they're going to charge you less because of your credit score. Another thing that I want to talk about is a term called compound interest. Compound interest is really interesting, no pun intended, because it's something that allows somebody who starts investing in the stock market or Roth IRA or something like that early on to end up making more money in the long run because of the compound interest. So basically, let's say you take $100 on something, you times it by a specific interest amount, right? What happens is that an initial amount begins to grow and grow because the compound interest is now multiplying not by that $100, but by that $100 times 5%. And then it grows and grows and grows. So it's called compound interest that happens over time. So this is something to where if you're looking into getting like a Roth IRA or something like that, it would be really beneficial, especially if you're younger, 17, 18, 19, 20 years old. This is the best time for you to do it because you'll end up having a significant amount of money 10 years from now because of compound interest. So interest is something that can work out in your favor when you understand what it is and how to utilize it. So here are your takeaways. Interest is the cost of money. So whenever you see percentages, you got to know that this is how much I'm going to be paying for this product in addition to the principal amount that the item cost. Number 2, a better credit score equals you pay less. Simple as that. You increase your credit score, you have the ability to pay less money for whatever it is over the term of the loan. And then number 3, banks want you to borrow from them, so choose wisely. You don't have to just go with any bank. We talked about this a couple episodes ago. You don't always have to go to a commercial bank. Sometimes credit unions have the ability to pay you more money than a commercial bank does. Having a brick and mortarless bank has the ability to also pay you more money because they have less overhead. So do your research and figure out, where should I house my money so that way I can make the most money off of my money, even while it's just sitting in an account. If you have the ability to invest into a Roth IRA, regardless of how old you are, you should do something like that, simply because of compound interest is on your side the sooner you start. So thank you for tuning in to episode 14, Plug Talk Tuesday. Interest. Let's grow.